Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in this video I'm going to share with you guys 5 different companies that are either fairly valued right now or undervalued. And the way the markets are going right now, I wouldn't be surprised if some of these companies come down and list another 5 to 10%. Now it would be amazing to have at least a 10% correction in the next few months just to kind of adjust things, because we have been going up for quite some time. For the last 2 years, the S&P 500 returned each year over 20%, in 19-20% or whatever it was in 2024, and 2023 and 2024 was over 24% or whatever it was. So it is really important that we think about the bigger picture rather than just focusing on right now what is happening in the fee and the fee and green index. You see this and then you're like, oh, basically the world's about to end, people are selling their stocks. And for if you are not a long-term investor or you haven't been investing for a long time, you might actually get scared and sell your stocks even at a at a loss, which is not something you should be doing. Something that we should be doing. We need to really have a long-term mindset. And if you see a stock that you bought a couple of months ago and it was up about 5% and now it's down 10%, look at the company. Do your basically your analysis about the company. Is everything still okay? Is the company still selling the same product? Yes, there might be some things that will affect the company, maybe with the tariffs and all the other things that's happening in the US. But generally, is the company still selling the same product? Are they still okay? So, for example, if we look at companies like Broadcom, for example, it still sells the same product that you were selling, a couple of weeks ago. And they are expected to basically grow their revenue, and they are expected to grow their earnings per share. So with regards to that side of things, everything is still intact. Visa is exactly the same, S&P and Global. So people are selling them because, remember, when someone sells for example, index funds or ETFs, these companies are included in them. So it affects all these companies. So when you see a lot of sales, for example, if you just look at basically last week, for example, okay, if we come out of this and we just look at just last, say, week performance, for example, you will see is a lot of red, especially on this side, especially on the technology side of things. If we look at for the 1 month, okay, you still a lot of red around. Now this might be a bit scary when you see that for the first time, but when you look at it for the last 3 months, okay, so a lot of the companies have been doing really well. Look, Broadcom is up about 17%. So I don't really care the fact that it's down about 6%, 5% or whatever it is in the last few weeks, but because it's up over 17% over the last 3 months. Now, when we look at the last 6 months, okay, you will see it's a lot of green again. And you can see now where some of the advantages are, basically some of the undervalued stocks are. For example, Merck, for example, AMD. There's a lot of companies, Adobe, that are down quite a lot. And these are high quality businesses. And when you look at the for 1 year performance, it's a different ball game. Because, of course, the stocks have been going up for quite some time, for almost 2 years now. There are so many companies like Broadcom and Nvidia's and so on that have done absolutely amazing. But look at the opportunities elsewhere. Okay, there's so many companies that are down a lot, but some companies have done, financials have done well, technology has done well, but consumer discretion, it hasn't done well. Oil companies haven't done, utilities. There's a lot of other companies, in the stock market. And year to date, this is what it looks like. Because of Trump coming in, there's a lot of uncertainty. The stock market does not like uncertainty. And this gives us a great opportunity, I believe, just what I believe. So year to date, as you can see, when it comes to the S&P 500, the Dow Jones, for example, the Nasdaq, and then FTSE is actually the only one that's doing really well. But you look at the last 5 years and it's a different ball game. So if you hold high quality businesses for the last 5 years that are, say, for example, the S&P 500, you'll be up 93%, which is absolutely amazing. So why do you worry about basically what's happening right now in the couple of days or whatever? If you haven't joined us in the Patreon account, you basically get a 50%, whichever basically section or whichever tier that you join, you get 50%, and then you've got access to a lot of things, inshallah. So if you can join us, that would be absolutely amazing. And now what I'm going to do is to share with you guys 5 different companies. Again, please do your own research. Don't just take my word for it. Okay, some of them are still fairly valued, some of them are undervalued. Okay, and the first company we're going to look at today is Salesforce. This company is probably one of the best companies out there. I will be buying more. I'm actually doing a whole video, inshallah, hopefully this week. So yeah, stay tuned for that. I'm gonna dig deep and find out exactly why the company was down a lot when they reported and so on. It has a market cap of 285 billion. It has a wide moat, $287 per share right now. They start paying dividends, but it's not, of course, it hasn't been paying for a very long time. When it comes to profit margin, we got 16%, return on equity about 10%, return on invested capital about 11%. Free cash flow, we're looking at over $12 billion, which is absolutely amazing. And the growth side of things, they're expecting the earnings to grow about 9% this year and then 8% for the following years. 3 stars right now. Basically, that means it's fairly valued. $315 per share is where they think the price should be. And as you can see, basically year to date is actually down about 14%, which is absolutely crazy if you think about it. Now, if you look at the financials moving forward, the earnings estimation, like what I've shown you now, that 9% is basically for January 2026, and then you've got 12%, 15%, 5%, and so on for the following couple of years. That's for EPS. And also for from revenue side of things, we're looking at about 8%, 9%, 10%. So the company is not dead at all. It's no longer one of those high growth companies. And if you look at it, there's 27 strong buys, 8 buys, 11 holds, and 1 sell. And you can see here 32% upside from where we are right now. $379 per share is where they think the price should be. So that's the first company. The second one that we're looking at today is Merck. And this is one of my favorite pharmaceutical companies, 233 billion market cap. It has actually basically pays 3% over almost 3.5 dividends right now. The payout ratio is very, very low. Latest increase was 5% and the 5-year growth rate of 7%, which is basically really what I'm looking for. Normally 6 to 7% or higher is what I'm looking for. 13 years of increasing that dividend, and then dividend safety on 90%, which is absolutely amazing. Profit margin, return on equity, return on invested capital, probably one of the best out there. Almost a $15 billion of free cash flow, 17% EPS expected to grow about 17%, sorry. Revenue 2%, and it's all for already 4 stars. So $111 per share is where they think the price should be. And a year to date is actually down about 6%. For the 1 year, it's down 24%. And look at this forward PE is about basically 10, which is ridiculously cheap. Now, if you look at the earnings expectations moving forward, that's 17% that we've already seen, then 10%, 10%, and then we've got again about 2%, 6%, 7%, 5% for the following couple of years. Now, in terms of the ratings from Wall Street, if we look at this, we can see 11 strong buys, 5 buys, 9 holds, and it's about 22% upside from where we are. $112 per share is where they think the price should be. Now, in terms of dividend side of things, you can see here from safety, from growth, from yield, is all consistencies, but everything is basically A+ or in the blue if you like. The next company is Autodesk. Almost $60 billion of basically market cap right now. It has a wide moat, $264 per share. It doesn't have any dividends. We've talked about this company quite a lot. It's been under my radar for quite some time. I think I did own it at one point in the family portfolio a very long time ago. I think it became overvalued, and then I sold it and took some cash off. But I can't remember how long ago this was. Probably about 3-4 years ago. Profit margin, we're looking at about 18%. Return on equity about 50%, return on invested capital of 26%, which is absolutely amazing if you look at this. Free cash flow $1.2 billion, and EPS is expected to grow about 12%. Revenue is about 13%, 3 stars right now. So $290 per share is where they think the price should be. Right now it's $264, so it is actually almost undervalued right now. And look at it, you see in alpha, you can see a year to date is about down basically about 10%. And if we look at the Wall Street expectations, okay, for this company, what they think, the 16% of them are saying is a strong buy, 6 buys, 10 holds. And again, these guys get paid to do these things, so just be take that with a pinch of salt. Always have margin of safety when you look in these companies, but 28% upside is a massive. $337 per share is where they think the price should be. Earnings expectations, we can see about 12%, 14%, 15%, 12%, and again 13%, 11%, almost a 10% there, which is absolutely amazing. The next company is Applied Material, one that we have been talking about quite some time. 128 billion market cap, white mud as well. It does have an excellent dividend. They have been paying this for the last 7 years, and basically its safety is about 86%. Profit margin, return on equity, return on invested capital, probably one of the best out there. Free cash flow almost to $6 billion. EPS is expected to grow at 8%. Revenue is expected to grow about 6%. 3 stars right now, $193 per share. But look at where it is right now, $150 per share is where they think the price should be. Now looking Seeking Alpha, a year to date is down 6%, but for the 1 year it's down 27%, where the rest of the Nvidias and all of these semiconductor companies have done absolutely amazing job. This one is actually about 28% down, which is crazy. And look at this PE as well. Forward period of 16 for this type of company is absolutely ridiculous. And when we look at the Wall Street expectations, or they basically got 20 strong buys, 6 buys, 10 holds, and 1 strong sell. And if you can see 37% upside from where we are, $207 per share is where they think the price should be. Now, if we look at the earnings expectations, okay, we've already seen that 8%, but 8% every single year for the next 3 years. That's basically year-over-year growth, and for EPS. And when it comes to the revenue side of things, we're looking at about 6% every single year. So it's decent. This is basically similar to, in my opinion, basically similar to Qualcomm. So in terms of like where the company is at right now, it's not too expensive, it's not too cheap, but one that I really like. And the final company we're going to talk about today is the best company when it comes to anything to do with semiconductors. Without this company, Nvidia will not be making as much profit as it is right now. Is Taiwan Semi, 819 billion, so it's heading towards that $1 trillion market cap sort of thing. Price right now $181 per share. They think the price should be $273. That's 4 stars right now. Really great company. Unfortunately, you cannot buy this in trading to an ISA account, but you can buy in the invest, and you can also buy into Interactive Brokers, which is basically where I own this company. And the dividend yield, we're looking about 1.6 right now. Basically the payout ratio 37%. Latest increase was 13%, which is really good, but they've only been increasing this for the last 2 years. Safety 62%. Profit margin, return on equity, return on invested capital are genuinely probably the best out there. $26 billion of free cash flow right now. 29% EPS growth expected next year, and revenue 28%. Absolutely crazy. And Wall Street is actually strong buy right now. 13 strong buys, 3 buys, 1 hold, no sales whatsoever. 34% upside, $243 per share is where they think the price should be. Earnings expectations moving forward, we've seen that 29%, 17%, and then 9%, 28%, 19%, and 18%, which is absolutely amazing. Now, if we look at the financials, I just want to show you here. Okay, $25 billion to $88 billion of revenue over the last 10 years. And look at this, almost the $50 billion of that total revenue of $88 billion becomes a gross profit. And when we look at the net income, $35 billion. I hope this is US dollar, because sometimes some of these websites, Taiwanese dollars, oh, there you go. It's actually US dollars. So there we go. That's perfect, actually. So yeah, $35 billion of basically net income, which is absolutely amazing. This is definitely one of my favorite companies out there. In terms of Sharia compliance side of things, again, nothing to worry about. All of these companies, because a lot of them are tech companies, they do have a low when it comes to the interest-bearing securities and low interest bearing debt as well. So overall, really great companies, ones to watch out inshallah in the next few weeks. And then inshallah, I've got a few videos planned. I've got 2, I think, for these 2, which and I think I've got 1 for Taiwan Semiconductor. So I will be releasing individual videos for these companies. So if you like that type of content, join us in the Patreon account, where you get access to a lot of things, including the Discord, a lot of the ETFs, a lot of the buys and sells, and all the other things that I share with the community. And of course, you can ask me questions on there. And last few days, basically I've got a lot of questions from brothers who are actually new to the market, who are genuinely struggling and thinking, you know what, I bought this company but they're down 10%, what do I do? And my message has been, like I've been saying last couple of days, when you look at the top part of my portfolio, you're like, oh, that looks amazing. But when you look at the top bottom part here, I've got companies that are down about £2,000. Am I worried? Absolutely no. I'm going to collect the dividend. I'm going to leave them alone. My plan is to hold these companies for 5+ years. Some of them been here in the portfolio about a year or so. So I'm just going to leave them alone. And I've seen similar thing. If you want to watch some of my really old videos, I think about 4 years ago, 3 years ago, you will see Merck was one of the companies that were down so much at one point. Right now, I've been up 22%. In fact, this company has at one point was almost £1,000 in the green. It has come down quite a bit recently, but again, I'm not really worried since it came back down. What have I done? I actually bought more shares, and I'm going to continue doing that. And I'm going to do the same thing with this. So your mentality has to change. If you bought a company and you know why you bought it, then why are you selling it? Because someone else decided to sell their product, right? So really think about that, inshallah. Anyway, I'm going to stop the video here. Have a wonderful day. Assalamu Alaikum.